China's role as the world's go-to global manufacturer might be at an end. The country's exports have gone down 24% when compared to last year's performance, and it seems like U.S. companies are the reason why. But how could a global powerhouse like China fall so far? Watch the video till the end for all the info. U.S. companies are cutting off China. American corporations are diversifying their supply chains. They're looking to cut out China from their production process. They may have realized that their sole dependence on China as a manufacturing powerhouse might come with consequences. This is a smart decision when it comes to businesses. By spreading out their supply chain to different countries, companies can diversify the risks associated with those countries, be it natural disasters, political instability, or economic upheaval. And it seems like China is the victim of this wave of diversification. Some companies have decided that they've been relying too much on China. A few of these include companies like Lego, HP, and Stanley Black & Decker. But what risks do these corporations want to avoid? There are two potential reasons for this shift. On one hand, companies are ditching China and moving their production back to the US. This is to keep their manufacturing close to their consumers. This is also known as reshoring. Another reason is to simply avoid being caught in the crossfire of America and China. It's no surprise that the tensions between these two countries are rising, and so companies may wish to avoid suffering the consequences of their relentless fights. Either way, China's #1 spot in global manufacturing is being questioned. This is the biggest challenge they faced since they entered global trade over 2 decades ago. Mexico, Vietnam, and Thailand are fighting for China's spot, but they still lack China's sheer size and world-class infrastructure. Several factors are contributing to this transformation of supply chains. The tariffs imposed on around 2/3 of Chinese goods by the Trump administration have slowed down new orders. Rising wages for Chinese factory workers have eroded one of the country's competitive edges. Chinese President Xi Jinping's state-focused economic agenda, crackdowns on private firms, and cautious approach toward the Biden administration have all contributed to a weakening of commercial relationships. China and the U.S. are not on the best of terms, and their behavior leaves much to be desired. The more hostile and confrontational they are, the more they affect the private sector. Corporations take risk into account when deciding which country to outsource a part of their supply chain to. Political and economic risks like these are taken into account when making that decision, and it seems like the risks outweigh the advantages for some businesses. So they're bailing on China and either moving back to the US or onto other countries. Now let's see how bad it really is between the US and China. Chinese products previously represented roughly $1 in every $4 Americans spent on imports. That is 25% of all imports to the US before the pandemic. And now they only account for around $1 in every $6. This is now only 16% of all imports to the US. This decline is partially the fault of the pandemic. And the US isn't the only country cutting off China. Japan is also reducing its reliance on Chinese imports. Meanwhile, European countries like Germany and France have shown more resilience in their trade relationships with China. Foreign investors are investing less in new Chinese factories. This means that other Asian countries might get a bigger piece of the American pie. They'll get to sell more things to the US. Annual spending on new factories in China went down from $100 billion in 2010 to $50 billion in 2019. It dropped to $18 billion last year. People think this trend of the US doing less business with China will continue. Analysts are unsure of how far it'll continue. Chinese manufacturers are also making moves. Some of them have decided to leave China's shores to dodge US tariffs. Others have gotten crafty. They send their products to other countries for some finishing touches. They obscure their Chinese origins in the process. So, Chinese manufactured products are coming into the US through Mexico or Vietnam. This tactic muddies the picture. It's hard to gauge how much of the $54 billion drop in U.S. imports from China in 2023 is offset by these maneuvers. Imports from Mexico are up by about $10 billion from 2022, but those from Vietnam have dipped by around $9 billion. The U.S. is also buying less from other countries. These include Thailand, Malaysia, Cambodia, Indonesia, and Taiwan. The Biden administration is trying to keep things cordial in the U.S. China trade relationship. They're reassuring China that the U.S. isn't looking for an economic divorce. Instead, they call it de-risking. They want to shift critical supply lines to either the U.S. or allied countries. However, the U.S. has restricted exports of advanced semiconductors to China. This is because of national security concerns. There may even be new limits on U.S. investment in Chinese tech sector soon. Even before the recent drop in U.S. purchases from China, trade between the two giants was shrinking. The U.S. and China traded roughly $690 billion worth of goods in 2022, but this was still 7% lower than their 2018 peak. While the trade numbers may fluctuate, the overall trend is pointing towards a shrinking U.S.-China trade relationship. They were down 12% compared to 5 years ago. Even though the numbers are down, a senior Treasury official says they're still quite significant. Something interesting happened in 2023, though. Mexico became the U.S.'s top trading partner. Manufacturers have been changing their preferences and using supply networks closer to home, rather than global ones. Since the trade war began in 2018, Mexico, Canada, and China have been taking turns being the #1 trading partner with the U.S. If not China, then who? Vietnam and Thailand are becoming go-to choices for companies wanting to move out of China while staying close by. India is also in the spotlight, with big players like Apple planning to increase iPhone production there. The electronics industry is leading the way. China's piece of the U.S. personal computer market dropped from 61% in 2016 to 45% in 2022. The same trend is seen in U.S. printer imports, where Chinese suppliers went from having 48% to just 23%. It is important to note that this shift isn't driven by governments, but by businesses themselves. Companies are deciding to change their manufacturing locations, not the White House. Chris Rogers, who heads supply chain research at S&P Global Market Intelligence, makes it clear. He says that governments don't do reshoring, it's the companies that do it. So it's the boardrooms, not the government offices, that are making these moves. Yet, these decisions are further propelling China into its downward economic spiral. Take Hewlett-Packard, for instance. HP is changing its production strategy. They plan to make more of their business laptops in Mexico and increase consumer laptop production in Thailand. This shift is part of a larger effort to improve the flexibility and resilience of their global supply chain. HP isn't leaving China. They still have 12,000 suppliers in China and a significant research and development center in Shanghai. Instead, they want to diversify their production sources. This approach aligns with lessons learned over the past few years. They want to be flexible and meet customer demands for multiple sources of production options. Stanley Black & Decker is also making significant supply chain changes. They aim to reduce their costs by a hefty $1.5 billion annually by 2025. And they plan to do this by streamlining their operations. They closed a Chinese factory a few years ago and now handle North American demand from a facility in Mexico. This strategic move aims to enhance customer service, boost innovation, and speed up product development. Toy giant Lego has also been changing its approach. In recent years, they've reduced shipments from China to the United States significantly. Back in 2015 to 2017, nearly 18% of their U.S. products came from China, but that number dwindled to just 3% in 2022. Mexico has stepped in as the primary source for Lego's U.S.-bound shipments, contributing to 70% of their supplies. Lego has been pursuing a regional sourcing strategy for about 15 years. They're a big player in the toy business. They know how to stay in the game. They're expanding where the business is. They've set up shop in Xiaxing. This is to serve the local market, and they're gearing up to open a whopping $1 billion factory in Vietnam in 2024. This is to meet the surging Asian demand. Looking ahead in 2025, they plan to open another factory in Richmond, focusing on the Americas. Why all this movement? It's about being close to their major markets. Lego knows that being near consumers is the key to quickly meeting local demand. It's also about shortening those long supply chains, reducing the chances of disruption, and lowering the environmental impact of shipping products over long distances. How's it looking for China? Let's not forget that China remains a manufacturing giant. It's responsible for 31% of the world's manufacturing value added. For comparison, the United States stands at 17%. China has a lot going for it, like top-notch ports, excellent highways, high-speed rail networks, and agile factory clusters that can quickly adapt to changing conditions. These advantages make China the go-to place for many products. These include electric vehicle batteries, kitchenware, aluminum doors, and window frames. Chinese suppliers still dominate these markets. Countries like Mexico, India, and Vietnam are trying to snag a piece of China's manufacturing action, but they won't overthrow China's dominance soon. China's manufacturing might is too colossal. Some say the decline in Chinese shipments to the U.S. isn't as severe as the data suggests. Chinese government reports tell a different story, revealing a smaller drop. U.S. and Chinese trade numbers have always had disagreements. This is partly because they differ in how they tally shipments through Hong Kong. The gap widened during the trade war. There's a suspicion that U.S. firms underreported imports from China to dodge tariffs. Changes in specific industries also play a role. Retailers like Target and Walmart are ordering fewer Chinese goods to trim surplus stock. Shifts in the Asian electronics trade add to the complexity, with some products now passing through Vietnam for final touches before hitting the U.S. Do you think these problems are as bad as the U.S. data makes it out to be? Or is this just a drop in the ocean for China? Leave a comment on your thoughts, and be sure to watch the next video.